Procter & Gamble just reported another solid quarter. The business remains strong. Its brands still dominate store shelves around the world, cash flow remains healthy, and management continues investing for the future. Yet instead of celebrating the results, Wall Street became more cautious. Why? Because investors weren't focused on what P&G delivered last quarter. They were focused on what the earnings revealed about the next few years. Has P&G's growth engine started to slow? Or is the market overreacting to a temporary shift in consumer behavior? In this video, we'll look beyond the earnings report to understand why Wall Street believes the growth story has just changed. Let's start with what hasn't changed. Procter & Gamble is still one of the highest quality consumer companies in the world. It owns category-leading brands, generates strong free cash flow, and has a decades-long history of consistent execution. None of that is suddenly in question. But Wall Street isn't debating the quality of the business anymore. Instead, investors are asking a different question: can P&G continue growing fast enough to justify its premium valuation? That's an important shift. Because when a company is already viewed as exceptional, simply delivering another solid quarter isn't enough. Investors want evidence that the next phase of growth will be stronger than the last, not merely stable. And that's where this story really begins. For the past few years, P&G had a powerful growth formula: raise prices, protect margins, and let the strength of its brands absorb the impact. That strategy worked remarkably well during the inflationary period. Consumers continued buying trusted brands, even as prices increased. But today's environment is different. Inflation has eased, shoppers have become far more price-conscious, and retailers are promoting value more aggressively. As a result, relying on price increases is becoming much more difficult. This is the first major signal Wall Street picked up from the earnings report. The old growth formula is becoming less effective, and investors are now asking what will replace it. If pricing power begins to fade, only one growth driver becomes truly important: volume. That's why investors are paying much closer attention to how many products P&G is actually selling, not just how much it can charge for them. Management acknowledged that consumers are becoming more selective. Many shoppers are choosing smaller package sizes, waiting for promotions, or looking for better value before making a purchase. This doesn't suggest P&G is losing its competitive position. Instead, it shows that demand is becoming harder to stimulate. For Wall Street, the next chapter of P&G's story won't be written by higher prices, it will be written by whether the company can bring volume growth back. If you only looked at the quarterly results, you might wonder why the market reacted so cautiously. The answer lies in the outlook. Management projected another year of modest sales growth while warning that higher commodity, transportation, and energy costs could weigh on profitability. In other words, the earnings didn't convince investors that growth was about to accelerate. Instead, they reinforced the idea that P&G may be entering a period of slower, more challenging expansion. That's why Wall Street looked beyond the numbers. The market wasn't reacting to what P&G achieved last quarter, it was reacting to what management believes the next 12 months could look like. Despite the slower outlook, management isn't changing its long-term strategy. Instead of cutting investment to protect short-term earnings, P&G plans to continue spending on innovation, advertising, product superiority, and brand building. That decision sends an important message. Management believes the current slowdown is not a reason to retreat, it's a reason to strengthen its competitive position. Of course, this approach may pressure margins in the near term. But Wall Street understands the trade-off. The real question isn't whether these investments will support next quarter's earnings. It's whether they'll be enough to reignite sustainable growth over the next several years. For years, P&G's growth story was easy to understand. Strong brands gave the company pricing power, and pricing power translated into steady earnings growth. But that formula is becoming harder to sustain. Now investors are looking for a different growth engine. Can innovation create new demand? Can premium products attract more consumers? Can international markets contribute more meaningfully? And most importantly, can volume growth return? These are the questions Wall Street is asking. The market isn't saying P&G has lost its competitive advantage. It's saying the company now needs a new catalyst to support the next chapter of its growth story. One reason the market reacted so strongly is simple: P&G isn't priced like an average company. Investors have long been willing to pay a premium because of its exceptional brands, consistent execution, and resilience during economic uncertainty. But premium valuations come with premium expectations. When growth begins to slow, even slightly, investors start questioning whether that premium is still justified. This isn't about losing confidence in the business. It's about whether future growth can keep pace with the valuation investors have already assigned. For a company like P&G, maintaining excellence isn't enough. The market also expects continued momentum. What's happening to P&G reflects a broader shift across the consumer staples sector. As inflation moderates, consumers are becoming more selective, retailers are pushing promotions more aggressively, and pricing power is no longer as dependable as it was a few years ago. That means even the industry's strongest companies must find new ways to grow. For P&G, the challenge isn't protecting its brands; they remain among the best in the world. The challenge is proving that future growth can come from stronger consumer demand, not simply higher prices. And that's exactly what investors will be watching over the next several quarters. The good news is that this story isn't fixed. Several developments could quickly improve investor confidence. A recovery in consumer spending could lift volumes. Successful product innovations could create new demand. And if commodity and transportation costs begin to ease, profit margins could improve faster than expected. P&G has navigated difficult environments before, and its scale gives it advantages that many competitors simply don't have. That's why Wall Street hasn't given up on the company. Investors are simply waiting for evidence that the next phase of growth is beginning, not just hoping that it will. At this point, Wall Street doesn't need another explanation. It needs proof. Proof that volume can recover. Proof that innovation can drive demand. And proof that long-term investments will translate into stronger, sustainable growth. That's the challenge facing P&G over the next several quarters. The company has earned investors' trust through decades of consistent execution. Now, it must earn their confidence again, not by defending its past success, but by demonstrating that its next growth chapter is already taking shape. It's important not to confuse a slower growth outlook with a broken business. P&G still generates enormous cash flow, owns some of the world's most valuable consumer brands, and continues investing for the long term. Those strengths haven't disappeared. What has changed is the market's level of confidence in how quickly the company can grow from here. The coming quarters will determine whether today's concerns are simply part of a normal transition, or the beginning of a more prolonged slowdown. Until then, investors are likely to remain patient, but they won't stop watching every signal. Procter & Gamble is still one of the highest quality companies in the consumer staples industry. The latest earnings didn't change that. What changed was the market's perspective on where future growth will come from. Wall Street is no longer focused on whether P&G can protect its business. It's focused on whether the company can create its next growth engine in a world where pricing power is fading and consumers are becoming more selective. That's why this wasn't really an earnings story. It was a story about changing expectations. And in the market, changing expectations often matter far more than changing earnings. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.